The efficient markets hypothesis asserts that current securities prices reflect all available information and expectations. So if current market prices offer the best available estimate of real value, then it's only going to be unanticipated future events that are going to trigger price changes. This is one reason for the apparent short-term randomness of returns. And it's because of this that investors may be best served through passive, structured portfolios, rather than trying to out-research other players in the market and guess which way the market is going. Investors who flee the stock market for the safety of cash may experience temporary relief from market volatility. But after leaving stocks, their anxiety may shift to concern over missing a stock market rebound while still sitting in cash. The above performance data offers a recent example of the unpredictability of stocks and the hazard of attempting to avoid losses through market timing. The main focal point of this slide should be the graph at the right side of the screen. The shaded area of this graph represents the huge uptick in stock value on March 10, 2009. If you had attempted to time the market and missed out on this singular day within the first quarter of 2009, you would have had significantly higher losses for the quarter. And this is the nature of stock investing. Gains typically come in powerful upsurges against a backdrop of discouraging financial and economic news. As the March 2009 rally demonstrated, a surprise rebound may frustrate investors who are waiting for a clear signal to return to the market. Of course, a brief period like this may not signal the start of a new bull market, but recent history does serve as a reminder of how suddenly a major turnaround can begin. An investor's job is not to predict bull and bear markets, but to be positioned to capture positive performance when it does occur. This is best achieved by holding a broadly diversified portfolio that reflects one's risk tolerance and investment time horizon. Many investors assume that stock returns follow the business cycle. According to this view, the stock market offers a higher expected return premium in a strong economy and a lower premium in a weak economy. The market premium here refers to the return of stocks over T-bills. In reality, the market premium tends to run counter to the business cycle, as illustrated in this conceptual graph. The premium is a function of how investors perceive their risk exposure in equities relative to cash or T-bills. So during recessions, as company earnings fall and investors become more risk averse, stock prices adjust downward, which raises expected returns. The possibility of earning higher returns compensates investors for choosing stocks over cash in these risky times. Conversely, investors will accept a lower expected return when they regard stocks as less risky relative to cash. This typically occurs when the economy is expanding and the outlook for company earnings is strong. As more investors choose to hold stocks, market competition drives up stock prices relative to company performance, which in turn reduces expected returns. Investors should not attempt to time the business cycle. Economic performance is only known after the fact, while stock prices tend to reflect the market's view of future business performance. As new information becomes public, stock prices adjust to provide equity investors an expected return that matches perceived risk. Investors are best served by diversifying across many stocks, maintaining a long-term perspective, and applying discipline throughout the business cycle. The efficient markets hypothesis implies that no active investor will consistently beat the market over long periods of time, except by pure chance. Yet active managers test this hypothesis every day through their efforts to pick stocks and time markets. The evidence shows that their efforts are not worth the high cost borne by investors. This slide displays the percentage of actively managed public equity funds that fail to outperform their respective benchmarks for each major fund category for for the 5-year period ending in June 2011. Most of the fund categories failed to beat their respective market benchmarks as a group. What we can learn from this is that it simply does not pay to play the game of active management.